The market experienced significant volatility this week, but on the eve of Thanksgiving, the Dow surged 493 points in a single session, with all three major indexes gaining nearly 1%. Small-cap stocks and healthcare sectors led the advance. The key question remains: is this 4.5% to 7.5% pullback just a pause after 7 consecutive months of gains, or the start of a new downtrend? A closer look at the structure. Dow and S&P 500 fell 2% this week. Nasdaq dropped nearly 2.75%. But small-cap stocks declined less than 1% for the week. On Friday, all 11 S&P sectors closed higher. Materials and healthcare jumped over 2%. Consumer, communications, real estate, industrials, and financials all rose more than 1%. Home builders surged 4.5%. Retail gained 3.5%. Regional banks climbed over 3%. The rally was supported by a further decline in long-term treasury yields, offering relief to interest rate-sensitive sectors. Policy signals are providing support. The Fed has effectively shifted the debate from whether to hike to when to cut. Focus is now on the interplay between unemployment and inflation. If job growth continues to slow, and core inflation keeps decelerating, the Fed will find it harder to ignore rising calls for rate cuts. But risks are building. AI sector valuations and high capex. Growth in private credit and leveraged strategies. Gold's sharp swings reflect rising risk anxiety rather than a clear directional signal. These factors are accumulating tail risks beneath the surface. The bottom line: current conditions suggest U.S. stocks are in a high consolidation phase, digesting valuations while investors gauge policy directions. In the coming weeks, the market will be driven by employment and inflation reports, any emerging credit events. These variables will determine whether the rally resumes or retreats. Follow for clear-eyed analysis and key market signals.